Well, Jim, thank you so much for joining us. We really appreciate you being here.
Great to be with you.
Your most recent book, Jim, The Road to Ruin,
Right.
outlines a fairly pessimistic look for the U.S. economy. Take us through, what factors you see ruining the U.S. economy.
Well, it's not just the U.S. economy. I would really say it's the global financial system.
Sure.
So you can have, there's a difference between a recession, a business cycle recession on the one hand, and a financial panic on the other. So for example, October 19th, 1987, we had a financial panic. The stock market dropped 22% in one day. If that happened today, the U.S. Dow Jones Index, that would be the equivalent of 5,000 points. Not 500 points, but 5,000 points in one day. But there was no recession. Yeah. Same thing in other examples of financial panic. 1998, Russia long-term capital. That was, we almost shut every market in the world, every exchange in the world almost shut down. Didn't happen because there was a bailout and they propped up the fund, they announced it. But there was a financial panic, but there was no recession. Then in 2000, we had a recession, but no panic. So they don't always go together. In 2007, 2008, they did go together. So what I'm really talking about is systemic crisis and financial panics and liquidity crisis, more so than a normal business cycle recession. And there I use complexity theory. And one of the things you learn about complexity theory is that the worst thing that can happen in a system, so in a complex dynamic system, the measure of risk is an exponential function of scale. Now what that means in plain English, scale just means size measured in certain ways. But if you double the system, you don't double the risk. You increase the risk by a factor of 10 or more. And since 2008, we actually have the 5 biggest banks in the United States are bigger. They have a larger percentage of the banking assets. They have larger derivatives books. In other words, everything that was too big to fail in 2008 is bigger, more interconnected today, which means that the risk is exponentially greater than it was then. So it's just a matter of some catalyst causing this next crisis. And the other point I make is that in 1998, with the hedge fund long-term capital management, and I was involved in that, I negotiated that bailout, so I have very good working knowledge of that, and the Russia financial crisis. So in that crisis, in 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. In 2018 or 19, who's going to bail out the central banks? Each crisis gets bigger than the one before, and we're at the point now where the next crisis is going to be bigger than the ability of the central banks to deal with it. So you're going to have to turn to the IMF to basically recapitalize the world.
So, Jim, do you think this is inevitable, or is there anything that can be done to sort of avert that next crash?
Well, I think it's practically inevitable. There are some things that could be done, and the analog I use, but it's more than an analogy, more than a metaphor, is the snowflake and the avalanche. So you're in the mountains, it's snowing, snowing, snowing. The snow's building up. An experienced person can look at it and say, look, that's dynamically unstable. That's going to rip loose, cause an avalanche. It's a threat to skiers or villagers below. And then one snowflake comes along and lands the wrong way, disturbs a few other snowflakes, creates momentum, creates a chute, creates a slide. The whole thing rips loose and the avalanche happens and people get killed. Who do you blame? Do you blame the snowflake or do you blame the instability of the system? I would say the snowflake's irrelevant. If it's not one, it would have been another. It was going to happen sooner or later. In other words, it is inevitable. You have to worry about the instability of the system. Now, in the real world, what do ski patrols do in the Alps and the, Whiteface here near Vancouver, or Whistler rather, near Vancouver? The ski patrol goes out in the morning and they set off dynamite charges. They set off cannons and they purposely cause little avalanches so you don't have the big avalanche. That's an example of descaling the system, reducing the size of the system so you have less risk. What would that mean in banks? It would mean breaking up the big banks. I think JP Morgan should be broken up into 5 banks. When I started banking in the 70s, it was 5 banks. It was JP Morgan, Chase Manhattan, Chemical Bank, Manufacturers Hanover, and a couple others that got absorbed along the way. So break up those big banks the same way that you break up a snowpack to prevent an avalanche. Ban all derivatives except maybe, I think, some exchange-traded derivatives, the old Chicago-style futures where there's some business purpose for it. It's not just gambling. There's a legitimate hedging function for it. There's room for speculators. They're risk managed, they're margin. Those are fine, but these over-the-counter derivatives and off-balance sheet derivatives, that's just another form of risk, just another form of gambling. So ban most derivatives, break up the big banks, bring back Glass-Steagall, separate commercial banking, investment banking. If you did all those things, I would be much, much more optimistic that we're not going to have the panic I'm describing. But then you say, what are the odds that those things are going to happen? I would say 0. Therefore, they're just not going to happen. Politically, the banks own Washington.
Yeah.
And so therefore the crisis is inevitable.
Well, then I guess it's no surprise that you have a case for gold. You think gold could hit 10,000 sooner rather than later?
Yeah, I talk about an intermediate price target for gold at $10,000 an ounce. When I say that, it's not a made-up number. I don't say it just to get attention or get headlines. It's actually the result of analysis. It is the implied non-deflationary price of gold in a system where you either are on a gold standard or you want to reference gold as a way to control your monetary policy. You have discretionary monetary policy with a gold anchor, in other words. Now, people say there's not enough gold in the world to support a monetary system. That's nonsense. There's always enough gold. It's just a question of price. At $1,300 an ounce, which is about where it is today, if you add up the amount of official gold, 33,000 tons at $1,300 an ounce, that comes out to a number which by itself is not enough to support commerce in the world. But if you raise the price to $10,000, then it is enough. So it's not a question of how much gold is there. There's always enough gold. It's a question of price. Now, I'm not saying there's going to be a gold standard anytime soon. There's not a central bank in the world that wants a gold standard, but they may have to go to one, not because they want to, but because they have to restore confidence in some kind of crisis of confidence in the dollar itself. If you do that, the monetary economists are going to say, okay, well, we have to get the price right. And what's the answer? The answer is $10,000 an ounce. That's the math based on the 24 trillion of M1 money supply in the U.S., China, Japan, and Europe, with 40% gold backing against 33,000 tons. It would have to be about $10,000 an ounce to support the 24 trillion at a 40% ratio. So it's analytically derived. It's not a headline, attention-grabbing number, but that's where gold will get to in a crisis.
Well, changing tunes a bit here, we haven't seen gold hit 10,000 yet.
No.
We have seen Bitcoin almost double that recently. Now, I know you're participating in a debate here about gold versus Bitcoin. Where do you stand on that? What's your take?
Bitcoin is interesting because it's a fraud, a Ponzi, and a bubble all at the same time.
So you like it?
Well, it's funny because you can have, like, for example, Madoff was a Ponzi and a fraud, but it wasn't a bubble. The tulip mania in the 17th century Netherlands was a bubble, but it wasn't a fraud because you got to keep the tulip. So in other words, it's rare to have all three, but Bitcoin actually is all three. Like some of these exchanges are bucket shops, they're Ponzi's, they're taking money in, they tell you you have Bitcoin, they didn't actually give you the Bitcoin, you just got a confirmation, they took the dollars, they're counting on new money coming in to cash out people. That's a classic Ponzi, that's going on. They're what are called wash sales. They're estimated to be about 1,000 people or entities who control 40% of all the Bitcoin. So they're what I call the whales. These are Bitcoin billionaires, Bitcoin multimillionaires, whatever. They have a huge interest. A lot of them are miners. They have a huge interest in propping up the price. So they do what are called wash sales. So I sell to you for 10,000, you sell back to me for 11. I sell to you for 12, you sell back to me for 13. It's called painting the tape. We're selling the same Bitcoin back and forth. There's no profit or loss, but we create the illusion that the price is going up, and then all the suckers come in. I'm reading stories now of garage mechanics in Korea who are hawking their inventory to put their life savings into Bitcoin, or millennials who are using their parents' credit cards, or people, lower middle class people taking out home equity loans. And these people are being decimated. These people bought at 15, 16, 17, 18,000. They've been wiped out. There are suicides. It's a really sad story. But Bitcoin has basically evolved into a way for rich, savvy people to steal money from poor people. So I can't really live with that. That's not a good model for me.
Well, Jim, it's always great to speak with you, and thank you so much for sharing your thoughts with us.
Thank you.